Hello value investors, thank you for joining me. Today I want to talk about FireEye and why FireEye is actually a very compelling investment. So, if you haven't done so already, don't forget to check out my stocks on Seeking Alpha. My marketplace is called Deep Value Returns. You're welcome to do a totally free trial to see if it suits you. So, we're going to talk about FireEye as a group of cybersecurity stocks. We're going to talk about the stabilization of its revenue growth rates and when the change is undergoing. Then we're going to talk about the divestment of the business and bring it all together to talk about its valuation. So let's get started. So it's quite interesting that I've got on the screen here three other cybersecurity stocks. You can see obviously CrowdStrike is the crowd favorite and that's done really well, but the rest of them, so for example I've got Palo Alto, Fortinet and FireEye, this group of cybersecurity stocks on a yearly basis are very much undistinguishable. So the market is pretty much saying, okay, there's a compelling opportunity in cybersecurity, but you can't really tell the difference. They're all pretty much the same and just people are just buying a basket of them. So whenever the market is not quite discerning, there's an opportunity there if you're willing to do a bit more work. So that's the premise that I'm putting out there. So FireEye last year was growing at approximately 5%. And this year it kind of started edging out slightly faster. And the reason for that is that there's this Mandiant Solutions that's growing faster than the rest of the business. So what FireEye has decided to do is decided to divest of its product business. So the product business is a higher margin business, but it's a slower growth. Okay, so they're getting rid of that. It's not a very compelling business. Makes a lot of sense. Get rid of that, and they bring in approximately 1.2 billion in cash. So FireEye's market cap is 5 billion. They get rid of the products business that's worth roughly 50% of the business, and they're left with the SaaS business. Okay, so 5 billion market cap, get 1 billion cash. So 20% of the market cap is now cash. Okay, that puts the emphasis on the underlying services business. So the Mandiant Solutions is going to be approximately in time by 2025. That's a target, that's a financial target. It's going to be 60% SaaS, 40% services like consulting. Okay, so the consulting is typically not as highly valued by investors, but the SaaS business, as you might know by now, is quite highly valued because it's quite a sticky product. So that's the pitch right there. You've got a business that's going to grow at approximately 20% compounded annual growth rate to approximately $1 billion by 2025. And it's got a business that's supposed to be quite attractive. So you can see here, that's a financial target for 2025 of 1 billion. And you got operating margins of approximately 20%. So on a rule of 40, the rule of 40 is how well the company manages its growth with its profitability. So on a rule of 40, it hits that 40%, which is typically highly regarded by investors. So it's balancing its growth prospects with its profitability. So that's an attractive business right there. Okay, so if you look at some of the other cybersecurity stocks like Palo Alto, that trades at approximately 8 times forward sales, so that's the cheapest one. And then you got Fortinet that trades approximately 12. If we take that figure that management said, okay, I've estimated this, so I've said, okay, they made 400 million from that from the Mandiant services. If I say that they make about 460 in 2021, that puts the stock trading at approximately 11 times forward sales. So if you take that figure, 11 times forward sales for the underlying business, and you're still going to have approximately 1 billion of net cash on the balance sheet. So you're going to have a strong balance sheet, and management thinks that the shares are undervalued, so they're going to repurchase approximately 500 million of their stock. So you're kind of viewing an open-ended repurchase plan of roughly 10% of the market cap. So you got a share repurchase going on the bottom line, you got a 20% growth on the top line. So it's possible that the investors might look to this business and say, okay, probably it's worth slightly more than 11 times forward sales. So that's the pitch that I think is kind of attractive. So I don't have any position in here, but this is something that is quite attractive to me. And just to summarize everything up, so you have a business divesting of some kind of low growth business, low growth segment, and you're going to be left with a bit more of a highly valued, highly praised services business. So if you haven't done so already, don't forget to check out our marketplace on Seeking Alpha. It's called Deep Value Returns. I'll tell you the stocks I own and why, and hopefully you'll find something that suits you there. You're welcome to do a totally free trial. See you soon.